Like life, I'll rise.
I refuse to accept the view that mankind is so tragically bound to the starless midnight of racism and war that the bright daybreak of peace and brotherhood can never become a reality.
We declare our right on this earth to be a man, to
All right, y'all, we're going to go ahead and start. What's this? Happy Sunday, Black History Month, first day of the new month, starting out in our trading week, second day of the first quarter, when we have the market pulling back. I am going to be going over using how to use proper risk management. I'm going to touch more on what I touched on last week as far as the ATR and further explaining what the ATR is and how to use that in your risk management and how that can actually level up your trading and kind of give you a better sense of direction with trading. Okay, we're going to start out with gold. The monthly high for gold is 48.94.33. The monthly low for 49.88. Monthly high 48.94.33. The low is 4449.88. Given a mid-month of 4666. Got 82. So we got the weekly and the monthly high the same. And the weekly low at 45.84.81. The low being 45.84.81. The high 48.94.33. Given a midweek, 47.37.04. So that's how your weekly should be looking now. Your gold. Move over to your 30. Monthly high at 48.912. Monthly low 47.946.9. So we got the monthly low 47.946.9. We got the monthly high 48.912. Given a mid-month of 48.427. We got the weekly.
My bros.
Oh, yeah, baby.
Only five. Oh, what's five?
Okay.
Yeah.
We got the weekly high at 48.933.8.
Give. Give.
The weekly low at 48.637.9. dot 5. A high 48,933.8. The low 48,637.5. Given a mid-week resistance of 48,785.4. So this is how your weekly and monthly should look for US 30. Gonna move over to Nas. Got the monthly high for Nas at 25,554.26. The low 25,283.13. 25,283.13. The high 25,554.26. The low 283.13. Given a mid-month resistance of 25,418.33. 25,418.33. Will look like the weekly and the monthly is like just about the same, but the weekly high is slightly higher at 25,560.64. The low 25,283.13. The high 25,554.33. 26. The high 25,560.64. It gives the midweek resistance at 25,421.51. Hold on 1 second, y'all. I'm gonna come over to Bitcoin.
Why laying the cake?
Got the monthly high at
Give me 5. 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 I want
monthly low. I don't think it is the new month candle. Monthly low 75. $612. Got 75. The low 75. 612.75. The monthly high 90.9.61. Given a mid-month resistance of 82,950.17. 2,950.17. Got the weekly high sitting at 86. 618. Got 01. Weekly low 76. 533. Got 05. The high 86. 618. Got 01. The low 76. 533. Got 05. Giving a midweek resistance of 81,419.53. And we're going to mark up the DXY, and then we're going to move on to talk about the ATR. I know y'all see it down here, but I'm going to give y'all the indicator so that y'all can know the ATR on y'all chart. The monthly high. The monthly high for the DXY is 98.268. Monthly low for the DXY is 97.008. Got the low, 97.008.
Right.
The high,
Give me fight.
26.
Give me fight. Give me fight. Give me fight.
Resistance of
Fight.
97. The weekly high of 97.712. We got the weekly and the monthly low the same. Giving a weekly low, 97.008. The high, 97.712. Giving a midweek level of resistance of 97.359. This is why gold is selling. As we got the DXY coming up. So I wanted to talk to y'all more on the ATR and why understanding and knowing it is important as far as using proper risk management with it. So the ATR, what the ATR basically is how much the candle moves on average. Like how many pips this candle is moving on average. So there is an indicator that you can put on your trading view. It's called the ATR value. It's set to the standard of 14 because how the ATR is determined is so it basically would take the high, how you would take the high of the candle and subtract it by the low, and that would be how many pips it moves on average. Okay. But they don't just use one candle. So if we're looking at the daily average on how many pips the candle typically moves on gold, and it's telling you 249 pips, 249 0.53 pips on average. It's measuring over the course of 14 days. So that's why you have the 14 here. So it's not just subtracting the high from the low. It's subtracting the high or the low over the average of 14 days. So what it did was basically took the high or the low of each candle. How you would determine the average. I know everybody is not math whiz, but math wise, how you determine the average is you will get the sum total of each candle for 14 days and divide it by 14. And this is what your average would be. So they do that so that you're clearing out the noise of the market. They always measure 14 candles. So the ATR is the average the candle is moving on average on any time frame. So you're looking at the day candle on average, it's telling you that gold moved 249 pips on average. So if you're trading by the day and you're trading based off of the day candle, your stop loss would be the 1.5 to 2 ATR, because you're looking to protect yourself for the next, like to hold that position for the next couple of days. If you're trading based off of the day candles, so it would be 1.5 ATR would be. Let me pull up a whiteboard. Hold up. Because we're gonna do some slight math. So 1.5 ATR would be, if you divide it. Hold up, let me stop sharing for a second and I'm gonna pull up a whiteboard. Because I want y'all to understand the ATR and why we use ATR. You don't just use it on a day candle. You use it on any time frame you trade it on. Okay? So if you're trading on a 4-hour and it moves, let me pull up a calculator. No calculator. Y'all can still see my screen, right? So if we're looking at
Yes.
all right, thank you. So if we're looking at the 4-hour, right, and we traded in accordance to the 4-hour, but we look at the 4-hour structure. Okay, what we would do is we would say 194, and we would divide that 194.97. You divide that by 2, and then add 194.97. That's 1.5 ATR. So 1.5 ATR would be 1.5 of the average of what the candle moved. That's what you will be looking at for a stop loss. You either do 1.5 to 2 ATR on your stop loss if you're looking at the 4-hour, if you're trading on a 4-hour. And if you're measuring, like this one went, oh, okay. You're measuring the candle, like this previous candle, yeah, moved only 208 pips. So like if it pulled back, it wouldn't have pulled you out of the trade on the previous candle. Like if it pulled back up here, it wouldn't have pulled you out of the trade. So that's why understanding the ATR is you're expecting to know how much it's anticipated to move in the candle. So your risk will be, you will be risking 1.5 ATR to profit. You can do 2 ATRs, will be two on average. Like, so if you're risking 292 pips on a 4-hour, you're looking to gain 194.97 times 2, 389.94 pips in a 4-hour candle, trading on a 4-hour. So regardless of what time frame you're trading on, so 194.97 times 2 would be 389. So you know I'm looking to stay in this position for 389 pips, right? Just measuring and move that in less than two 4-hour candles. You can potentially hold it for longer. You can potentially hold it for 3 ATR because you know how much on average the candle is moving. Even looking at the 1-hour structure, it's the same thing. I know on average the candle moves in an hour 130 pips, 130.82 pips. I'm looking risk to reward rise at minimum on a 1-hour candle, 130.82. Divide that by 2 plus the 182. Wait a minute, I lost track here. 130.82 divided by 2. And then that's plus 130.82. 196.23. So that's how many pips you should be risking in an hour to protect yourself in the trade. If it doesn't move past 1.5 or 2 ATR, you're safe in that position. So you're not getting out prematurely, and you're not over risking, and you're over leveraging and over risking in the trade. You're risking that 196 on a 1-hour, and you're looking to gain 130.84 times 2, 261 pips. You'll likely be holding that for probably like another hour. Like 261 pips would be down here. So that's what you're looking at on any pair that you are trading. The reason you are using the ATR is because you know how much on average the candle is moving within that time frame. That changes the game for your trading. Knowing how much this pip moves on average, you can look at any pair that we just marked up. Okay, and it's going to give you the average over the past 14 candles. If you're looking at the 1-hour, the average on how much the candle is moved. Each candle is moving the last 14 hours on average, and moved 130 pips, 130.84 pips. Bitcoin. 1,182 pips. And they're measuring this over the course of 14 candles. So that's 14 hours of measurement. On average, it's telling you that it moved 1,082.35 pips. Even if you wanted to go for a 1-to-1 on a Bitcoin and hold it for that 182 or double the ATR, hold it for two hours, that would be over 2,000 pips. Understanding how much the candle moves and how much you're anticipated to hold takes out the FOMO in trading, and it also gives you an advantage of knowing how long to hold the trade, one, and how much to risk going in. That's where proper risk management comes into play. So understanding that and understanding that you're trading from the structures, okay, you're trading from the higher time frame structure, you knowing how much this candle is anticipated to move on any given time frame. Add this to your trading view, even if you have to take some other stuff off, the ATR value. It's already preset to measure the 14. So you're not doing the math for you. Only thing you will be doing the math on is your stop loss. US 30, it tells you here, on average, it moves 189 pips on average in an hour.
Why? Yeah.
Okay? So you understand how much is moving in an hour. On average, I can hold this for double that ATR. So I'm going to hold it for I'm holding for 2 hours. If you're trading on a 30-minute, on average, I'm going to hold it for 1 hour, 137. Time 2 is 274 pips. Because it's telling you on average it moves 137 pips in 30 minutes on average. So holding it for that would be only holding it for an hour. Understanding that, you know how long you're going to be in the trade. You're not guessing. You don't have to fear of missing out on the trade. Another way to using this and determining your entry and exit with the ATR. Okay, how you know the ATR is like shifting momentum and moving in your favor. You want to take a look at the engulfing candle, because an engulfing candle is indicating that there is a change of direction. When you see an engulfing in the market, that's where the money came into the market at. So that is why we use engulfing candles, because we're looking at where the money came in at, and we're looking at these engulfing candles on a higher time frame. So this explains where the money is coming into the market at. That's where the high volume of orders came in at. So when we see in it right here, we have on gold an order block here, but we looking for the engulfing that came out of there. This was the engulfing right here. Now we would take the fib tool here, okay, or to determine an entry. You're determining like, okay, I see this candle right here engulfed and closed out several buy orders here. It engulfed the previous candles, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 candles. It engulfed. So a high volume of sell came in right here. It typically pulls back. Entry-wise, using the fib for entry. Okay, you're going to put the fib on the engulfing. Your entry would be You can enter at the 0.5 level, but the 6.18 level is the golden ratio. That's the golden level of the fib. So you can enter here. You would have entered here. One of the engulfing candle. Because that's what you're looking for it to pull back to. It would have never took you out of this trade here based off of you using the 1.94 ATR, 1.5 ATR stop loss. It would have never took you out of this trade. Your stop loss would have been above the order block, above the engulfing, and you could have rolled it down to 2 or 3 ATRs and just kept setting your thing into profit. Any questions on the ATR? So if we have no questions, okay, y'all all got the document that I sent out explaining how to use the ATR with the strategy in conjunction with the strategy on how to, but the ATR is primarily used for risk management. Okay, to be able to understand how much you're supposed to be risking in your trade. Not monetary, you shouldn't be risking no more than 1 to 1.5% of your trades. But your lot size should be measured in accordance to 1.5 ATR to 2 ATR if you want to give yourself more leverage in a trade, depending on how long you want to hold it, and then depending on what time frame you want to trade on. So it doesn't matter what time frame you trade on, it gives you that ATR right here, even if you're coming down all the way to the 15-minute. Even if you're trading on a 5-minute. It's telling you on average, every 5 minutes, gold is moving 39.61 pips. So it doesn't matter what time frame you're trading on. You should be using the ATR as your stop loss, 1.5 to 2 ATR as your stop loss to give yourself space in your trade. And if it pulls back out of that 1.5 to 2 ATR, that's the trade becomes invalid. Don't chase the trade. Any questions? So I did give out the document last week explaining on how to utilize the ATR, but I did want to touch more on what the ATR is and how it is used and how you're supposed to be using it. Y'all got a foolproof strategy here. Nothing changes if nothing changes, y'all. Get in the market and get this money, okay? That money energy is all through this market. Trillions of dollars is traded on a Forex market. That money's ours. Let's go in and get this money and stop playing. We know we got all the tools and everything we need. Let's go in and get this money, okay? We're going to go ahead and end this out.
Paper route.